Welcome back, guys, to another Zero DTE podcast. We're on Season 2, Episode 29, where Ernie talks about leveraging volume profiles, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's course. Enjoy, guys.
This is 0 Days to Expiration, and this is a two-part series, second part of how to profit using 0 DTE and volume profile, and how we use volume profile in the context of our strategy. Now, if you've been following me for a while, then you know that I've been an advocate of volume profile for a very long time. In fact, I started teaching volume profile to Bitcoiners back in 2016, and I think I trained, maybe 2,000 people in the Bitcoin and crypto community. I think I'm largely responsible for most of crypto using volume profile to this day. Just my guess, but I was the only one doing it, and now everyone's doing it. So anyways, I have a very unique way of looking at volume profile. I've been a study of market profile prior to that, and then was intrigued with a lot of the ideas of Dalton and others, but I largely disagree with almost everything that they have to say from a short-term basis. I do not believe volume profile is a very useful tool, although it can be used in the short term. I think that looking at it from a very big picture point of view is far more powerful, and it allows you to see things that in the short term have very little relevance, or at least advantage over the long term. And a lot of this came to light when I started studying some works by Benoit Mandelbrot, very famous mathematician that brought us things like fractal geometry and the Mandelbrot set. He had this idea of something called market memory. And market memory is this feature in just about, it wasn't just for markets, first of all, it was more like systems memory, but he did an academic paper on markets in particular. His original thesis or discovery was done off of water basins and how levels of water tend to repeat themselves based on, even without regard to the amount of water that was dropped in a rainfall or whatever, and had this kind of memory that would persist over decades. And then he extended that to financial systems and markets. And then there's been a number of academic papers written on it, on how volume profile can be used to determine where there are support and resistance levels, areas of liquidity, areas of illiquidity, and these inflection points in the market that are a lot like scars that you would get. You got a scar 10 years ago, you can still see, well, you got a cut 10 years ago, you can still see the scar 10 years later, but you know that there's not a single cell in that place where that scar is that existed when you got that cut, but the scar remains. So that's a pretty much a direct analogy to what market memory is about, where you have these abrupt changes in volume that occurred over a long period or over a long time ago, and then get repeated over time, and you create this kind of indelible mark or structure in the market that affects price in the real time. That's the important part. Things that happened a decade ago or that get repeated over time are having a direct impact to market direction or behavior today in the present moment. And so we use this property, this market memory, in our profit-taking strategy with 0 DTE. So that's how we use volume profile. We also use some patterns, some price action patterns, but very, very few. The volume profile is really the linchpin of what gives us confidence in whether or not to hold or fold our position. Now, as a reminder, our strategy is also unique, the 0 DTE strategy, and it is patterned after what most pros employ in terms of the components of their strategy. And the primary premise behind it is asymmetry, asymmetric risk to reward, and that allows us with small drawdowns, stability over our equity curve, and also allows us to stay in the game and be available for unforeseen profit-taking opportunities. Then the other half of that is premium collection, obviously 0 DTE, collecting premium on the very final day of expiration when premium is decaying at its most rapid rate in the shortest period of time. So we combine that asymmetry, excuse me, We combine that asymmetry, basically casting a wide net using the butterfly as our primary strategy method, and then collecting premium. In the course of collecting that premium, we have a process. And that process is defined largely by a framework that we create that we use to identify where and when price is and how to behave or how to act at the intersection of this where and when dimensions. And then we'll use volume profile as the underlying structural element to help us make informed decisions within that context. I know that's a big mouthful. When you're a professional at a particular strategy, you need to have that kind of delineation, that kind of methodology, that framework, so that you can effectively manage a trade over a period of time. And it is what allows us to employ a continuous improvement process that is constantly iterating over these ideas and then journaling and logging and journaling and then reviewing on a weekly, monthly, quarterly basis until a trader becomes highly skilled at every aspect of the trade. Last week, what we did, first of all, take some coffee. Last week, I showed you how we go about marking up the volume profile to identify those inflection points in the market, and also how they're used. Probably didn't go into as much how they're used. Today, I'll show you how they're used and how we would use it in the context of a trade. All right. So what we'll do is, first of all, now we trade options on the indexes. Now, indexes are calculated things. They have no volume, so there is no profile per se for the SPX or the NDX. So what that forces us to do is to look at the futures, which is basically priced exactly the same. It may be offset depending on where we are in the life cycle of the futures contract. As the life cycle approaches expiration on a futures contract, it starts approaching parity with the index itself. So right now we're kind of like in the middle. The beginning of the futures contract for both the NASDAQ and the S&P started in March, and it will end in June. So we're only about a third of the way through. Now, what we're going to do is we're going to look at the profile in the futures and then translate that to the index when in our trade. And it's a simple offset that we use. We keep track of the difference between the futures price and the index, and that will give us the offset and then how many strikes that we have to go. And we won't really go into that in great detail. We'll just be looking at the futures so that we can show the methodology. All right. So let's start with the SPX, or actually, in this case, the E-mini S&P futures. And so we'll go to the big chart. I'm going to back up to the daily so you can see where we left off last time. We created this structure. The structure is identified by these lines, and you'll see that there are purple lines that outline the nodes, and then there are yellow lines that identify the volume wells or the low volume levels, the lowest levels, these sort of chasms. You'll see these really deep crevices. Those are all impactful. Those are places where the market has found, for whatever reason, a significant area or a transition from one below that level to above that level. And so at that level, even over the course of years, for whatever reason, markets tend to avoid that level. Why? Market memory. They remember whatever happened years past, and they continue on with that same behavior when price reaches those levels. I don't know how you would go about explaining it or proving that's what happens. It doesn't matter. All that matters is that it does happen, and that by marking it up and then in this large time frame, see, you can see that I'm looking at 2 years of data here. Now, I've only marked up the areas that I'm really interested in, those that are likely to come into play with current price. And so that's why I've only marked up around here. I certainly could go higher up here. For instance, if I wanted to put another LVL in there above, I could copy and paste this guy here and then place it right inside of that little chasm right there. That would be a good place. One could make an argument that right in here is a good place. Actually, this falling edge is probably even more impactful. So we'll look at that as well. Probably right about there. I think you'll find as price gets up there, you could even make an argument that right here, but it looks like right there is a good spot. Maybe we'll make that. Anyways, it looks a little weaker than others. So what I'll do is I'll make it a little bit darker. Something like, I don't know, like that. So I have a little system. I use colors and the thickness of the lines to indicate what the relative strength is or what feature that they're marking up. So when we zoom in to present day so that we can act like day traders, because we certainly can't do it at this level, we'll find that these lines are providing, here you can see support, here we're riding along, this is the edge, these are purple lines, so this is showing inside here is that big volume node, and we tried to break out of it, and this is just one of many attempts that we've tried to break out. If we zoom back out a little bit, you'll see. So in these few days, we've tried to break out into this low liquidity area, and had we breached this other level above here marked by the yellow line, we probably could have gotten into that low liquidity area and started this move upward. Now, we've been trying to do this for quite some time. So if we go back, we'll see that we've been contained by this volume node. That's where most of the volume is happening, and hence we're creating this kind of short-term local node that is really falling in line with the bigger node that has been going on for a couple of years. And the edge of this node is being respected. You see that very clearly. All right, and if we go back to way back, you'll find that the same thing is happening. Now, these levels, the behavior of them, we have behavioral aspects to them too. Generally, when price is inside of a node, it tends to consolidate, as you can see here. And then when it leaves the node, it tends to trend, as you can see here, right here. A very definitive behavior. And so by having that in mind, we can create potential scenarios where price is likely to go as it traverses these various volume profile structures. And that's how we develop our support and resistance zones and our potential scenarios, and how we can derive the trades that we may or may not make as they traverse these structures. And so that is exactly how we would do that. So as an example, today, price came out of the node, and my thinking was that we were going to have a move right down to this LVL here, like that, right? And my plan was one of a couple of things. So we set up a scenario here. If we break out of the node and then into this lower liquidity area, we first come across this LVL, which will provide a gateway. Either it's going to get rejected or move through. Now, it never made all the way down here, which is a little unusual, but you can see that has happened in the past. And one of two things would probably happen. Either it would get rejected back up, which is really the case here, or it would continue through down to the next level, wherever that might be, which is like down to here. So now we've created a couple of scenarios that we can create or stage trades and play them. Now, once entering back inside of the node is another possibility. So one can probably do something like this and say, okay, if we break back inside the node, one of the normal things it does once it gets in the node is starts traversing that node from top to bottom. And you can see that recently it has come up as high as here. So the idea here was, okay, it came out here. If we pass through here, I would go short. If it turns around, now I'm looking for it to enter back into the node. And it looks like we're developing a little bit of a child node or a short-term node that it's likely to go back up here. So there's two trades that I have. I have this trade, which I'll put in, I don't know, purple. And then this trade right here that I'll put in green. So here are inflection points and here are decisions based on the behavior that we would normally see. Now, this trade looks like it would be the one that we would go after. And if we have our strategy already in place and we're trying to contain or capture profit, then I'm going to be looking for these events. Now, if we were in profit here, let's say that there was a butterfly that was, I don't know, sitting like right here as an example, and I am in profit. Let's see, I'm in profit like this, maybe something like that. So I'm sitting here, I'm in profit. Do I hold or don't I? Right? Once it breaks through back into this node, I'm thinking, okay, it's exiting my profit trend of my butterfly. I'm going to break that trade, get out of it, take the profit that I have, and be happy with it. And that's pretty much what happened. So that's how we use the volume profile, those types of decisions. Partly on price action, partly on breaking various levels and changing behavior according to the structure. There you go. There's a actual real trade that happened today. The position of the butterfly might be a little bit off, but it's very close. That actually happened today. Now, another possibility, a trade that I put on was a fly a little higher. I put a fly up here later in the day, up here like this. It was way up here. And once it broke here, I added this fly with the idea that this would move up towards it. Now, it did move up towards it. Now, if you look very closely, not only did it move up towards it, but it also pulled back. And on the pullback, before the pullback happened, I was in profit. On that pullback, I actually exited for a very small profit. You might think that, why didn't you hold on, Ernie? Couldn't you have anticipated that it would continue up towards your fly? No, I didn't. But what I did take the trade based on its breaking through here. And so I was able to get a fair amount of profit here, and I wanted to retain it. So I applied my rules basically at the trailing stop. And once it exceeded the trail, I got out right around here. And so that allowed me to collect the profit that it made as it approached the fly. So there's another way I use volume profile today. So there you go. There's volume profile in the context of zero DTE, an extremely powerful tool. It is, I think, using the market memory type of paradigm with volume profile is perhaps one of the most powerful technical analysis tools, because you're looking at absolute objective evidence of market structure, not things that you're deriving from, say, moving averages or a trend line or an indicator. This is physical, objective evidence where these levels exist in the profile. So there you go. That's all I've got to say for today. Hope you enjoyed this. Let's see. We have a couple of comments. We have Lonnie Smith. Greetings. I believe I'm going to look into your service. Do you believe this style would help for swing trading other stocks? Volume profile certainly can help in trading for other stocks, in any kind of trading, in any time frame. I use volume profile, and I also use our butterfly strategy, the zero DTE strategy, in longer term, like 4 DTE trading Tesla stock, for example. So it's possible, but the service itself is designed specifically to help you become a consistently profitable, independent, professional level trader. So if you're interested in that, then yeah, try out the service. JMO Jones, how you doing? Bob, run off with your pool table. It's been a minute since I've been here, and I guess, yep. What JMO's referring to is Bitcoin Bob, or Bob. That's my body opponent bag. He's the guy I beat up on a regular basis. Yeah, he's sitting right over there, over by my new kitchen. And yeah, he'll probably receive a beating a little later on. All right. Well, thank you all very much. Take care. Peace to you all. Time for the music.